Investing might seem like a daunting maze, especially with the constant bombardment of financial jargon and ever-changing market trends. But the truth is, building wealth doesn't require complex algorithms or insider knowledge. It's about making informed decisions and staying committed for the long haul. Like a sturdy oak tree that weathers all storms, a well-structured investment portfolio can stand the test of time. This essay aims to demystify the world of investing by focusing on three prominent investment funds: VOO, SCHG, and SCHD. These funds offer a simple yet effective way to participate in the stock market's growth potential. Over the next few sections, we'll embark on a journey to understand each fund's mechanics, analyze their historical performance, and project their potential value over a 20-year horizon. Imagine yourself 20 years from now, reaping the rewards of disciplined investing. Your initial investment has blossomed, providing financial security and peace of mind. This is the power of compounding, the snowball effect of earning returns on your initial investment and the accumulated returns over time. Our goal is to equip you with the knowledge to choose the investment path that aligns best with your financial aspirations. By understanding the nuances of each fund, you'll be empowered to make informed decisions that pave the way for a brighter financial future. This isn't about chasing quick riches, but rather cultivating long-term wealth through strategic and consistent investing. Let's delve into the world of VOO, SCHG, and SCHD, unraveling their potential and guiding you towards a future where financial freedom is within reach. In the vast landscape of investment options, exchange-traded funds, ETFs, have emerged as a popular choice for both seasoned and novice investors. These funds offer instant diversification by pooling money from multiple investors to invest in a basket of assets, such as stocks or bonds. VOO, SCHG, and SCHD are three such ETFs that provide exposure to the U.S. stock market, albeit with distinct approaches. VOO, the Vanguard S&P 500 ETF, mirrors the performance of the S&P 500 index. This index comprises 500 of the largest publicly traded U.S. companies, representing a significant portion of the U.S. stock market. SCHG, the Schwab U.S. Large Cap Growth ETF, focuses on large-cap companies poised for accelerated growth. These companies are often characterized by their innovative products or services and potential to disrupt their respective industries. SCHD, the Schwab U.S. Dividend Equity ETF, prioritizes companies with a consistent track record of paying dividends. Dividends are a portion of a company's profits distributed to shareholders, providing a steady stream of income alongside potential capital appreciation. These three funds offer distinct ways to participate in the growth of the U.S. stock market, each catering to different risk appetites and investment goals. Over the next few sections, we'll delve deeper into each fund, analyzing their historical performance, expense ratios, and potential for future growth. We'll explore the factors that have driven their past returns and project their potential value over the next 20 years based on a hypothetical $5,000 investment. This analysis will provide you with a comprehensive understanding of each fund's strengths and weaknesses. Remember, investing is not a one-size-fits-all endeavor. The most suitable investment strategy depends on your individual circumstances, risk tolerance, and financial objectives. By carefully considering the characteristics of VOO, SCHG, and SCHD, you can make informed decisions that align with your long-term financial goals and set yourself on the path to financial well-being. The VOO ETF presents a compelling way to participate in the growth of the U.S. stock market by tracking the S&P 500 index. This index, a collection of 500 of the largest publicly traded U.S. companies, offers broad market exposure, acting as a barometer for the overall health of the U.S. economy. By investing in VOO, you're essentially buying a tiny piece of these 500 companies, allowing you to ride the waves of their collective growth. One of the most significant advantages of VOO is its low expense ratio. This ratio represents the annual fee charged by the fund manager to cover administrative and operational costs. VOO boasts a remarkably low expense ratio of 0.03%, meaning that for every $1,000 invested, you'll only pay 30 cents in fees annually. This low-cost structure ensures that more of your investment is working towards generating returns, maximizing your potential for long-term growth. Furthermore, VOO offers unparalleled diversification, with holdings spread across various sectors, including technology, healthcare, financials, and consumer discretionary. The fund mitigates risk by reducing exposure to any single company or industry. Even if one sector underperforms, others can cushion the blow, ensuring a smoother investment journey. This diversification is crucial for long-term investors seeking to weather market fluctuations and achieve consistent returns. VOO's investment strategy is inherently passive, meaning the fund manager aims to replicate the performance of the S&P 500 index rather than actively picking stocks. This passive approach, coupled with its low fees, makes VOO an attractive option for investors seeking a hands-off approach to investing. It's like setting your financial ship on autopilot, allowing the market's natural growth to propel your investment forward over time. The S&P 500 index has a rich history, serving as a benchmark for the U.S. stock market for nearly a century. Over the past 90 years, the index has weathered numerous economic storms, from the Great Depression to the dot-com bubble burst, consistently trending upwards over the long term. This historical resilience demonstrates the power of investing in a diversified portfolio of large-cap U.S. companies, reflecting the inherent growth potential of the American economy. Since its inception, the S&P 500 index has delivered an average annual return of around 10%. This means that, on average, an investment in the index has doubled in value approximately every 7 years. While past performance is not indicative of future results, this long-term track record provides a glimpse into the potential of investing in SCHG, which aims to mirror these returns. Of course, investing in the stock market always carries an element of risk. The value of your investment can fluctuate in the short term due to various factors, including economic downturns, geopolitical events, and changes in investor sentiment. However, SCHG's diversification and the historical resilience of the S&P 500 index offer a degree of protection against significant losses, particularly over the long term. By investing in SCHG, you're essentially investing in the future of the U.S. economy. The 500 companies that make up the S&P 500 index represent a diverse range of industries, reflecting the dynamism and innovation that drive American business. As these companies grow and adapt to changing market conditions, so too does the value of your investment in SCHG, offering the potential for significant capital appreciation over time. Shifting our focus from the broad market approach of VOO, we turn our attention to SCHG, the Schwab U.S. Large Cap Growth ETF. This fund caters to investors seeking potentially higher returns by concentrating on a specific segment of the market large-cap growth stocks. These companies, often household names, are characterized by their potential to outpace the market in terms of revenue and earnings growth. SCHG tracks the Dow Jones U.S. Large-Cap Growth Total Stock Market Index, which selects companies based on specific growth criteria, such as projected earnings growth and sales history. This targeted approach provides exposure to companies at the forefront of innovation, those disrupting industries and driving technological advancements. Investing in SCHG is akin to placing your bets on the future leaders of the business world. One of SCHG's most appealing features is its low expense ratio, mirroring VOO's commitment to cost effectiveness. At a mere 0.04%, the fund ensures that the vast majority of your investment is channeled directly into the growth potential of the underlying companies. This minimal fee structure allows your returns to compound more effectively over time, amplifying the impact of your investment. However, it's essential to acknowledge that higher growth potential often comes hand in hand with increased volatility. Large-cap growth stocks can be more susceptible to market swings and economic downturns, as their valuations are often based on future expectations rather than current performance. This means that while SCHG holds the potential for outsized returns, it might also experience more significant dips during periods of market uncertainty. The volatility inherent in growth stocks shouldn't deter long-term investors. In fact, it presents an opportunity to buy into promising companies at potentially discounted prices during market dips. Remember, investing is a marathon, not a sprint, and short-term fluctuations are par for the course. SCHG's focus on large-cap companies provides a degree of stability, as these established players often weather economic storms better than their smaller counterparts. Historically, SCHG has demonstrated impressive growth. Over the past decade, the fund has consistently outperformed the broader market, reflecting the strength and resilience of the large-cap growth sector. While past performance is not a guarantee of future results, it highlights the potential of investing in companies positioned at the forefront of innovation and technological advancement. One of the critical factors driving the growth of large-cap growth companies is their ability to adapt and innovate. These companies are not content with resting on their laurels. They constantly seek new ways to improve their products, expand their reach, and capture a larger market share. This relentless pursuit of growth makes them attractive investment prospects, particularly for those seeking long-term capital appreciation. Investing in SCHG is a bet on the future of innovation. It's about aligning your investment with companies that are shaping the world we live in, from revolutionizing communication through smartphones to developing life-saving medical technologies. While the road might be bumpier than with broader market ETFs, the potential rewards can be significantly higher for those who stay the course. Remember, investing in SCHG requires a certain level of risk tolerance and a long-term investment horizon. This fund is not for the faint of heart, but rather for those who believe in the power of innovation and are willing to ride out the inevitable market ups and downs. The key is to stay informed, stay invested, and let the power of compounding work its magic over time. Now let's turn our attention to SCHD, text overlay SCHD, the Schwab US Dividend Equity ETF, which takes a different approach to building wealth. Unlike VOO, text overlay VOO, and SCHG, text overlay SCHG, which primarily focus on capital appreciation, SCHD, text overlay SCHD, prioritizes companies with a proven track record of paying dividends. This strategy provides investors with a steady stream of passive income alongside potential growth in the value of their investment. SCHD, text overlay SCHD, tracks the Dow Jones US Dividend 100 Index, which selects companies based on factors like dividend payment history, financial stability, and growth potential. This rigorous selection process ensures that the fund invests in companies with a high likelihood of maintaining and potentially increasing their dividend payouts over time. This makes SCHD, text overlay SCHD, an attractive option for income-oriented investors seeking a reliable source of cash flow. One of the key advantages of SCHD, text overlay SCHD, is its lower volatility compared to growth-focused ETFs like SCHG, text overlay SCHG. Dividend-paying companies tend to be more established and less susceptible to market swings, as their valuations are often supported by their consistent earnings and dividend payouts. This makes SCHD, text overlay SCHD, a potentially suitable option for investors with a lower risk tolerance seeking a smoother investment journey. Moreover, SCHD, text overlay SCHD, boasts a low expense ratio of just 0.06%, ensuring that your investment dollars are primarily directed towards generating returns. This cost-effectiveness, combined with the potential for both income and growth, makes SCHD, text overlay SCHD, a compelling option for investors seeking a balanced approach to building wealth. Section 2. Reaping rewards, managing risks. While SCHD's focus on dividend-paying companies offers several advantages, it's essential to acknowledge that dividends are not guaranteed. Companies can choose to reduce or even eliminate their dividend payments if they face financial difficulties or decide to reinvest their profits back into the business. However, the companies included in SCHD's index are generally well-established, financially sound, and committed to rewarding their shareholders through consistent dividend payouts. Historically, SCHD has delivered competitive returns while exhibiting lower volatility than growth-oriented funds. This balance between risk and reward makes it an attractive option for investors seeking a more conservative approach to participating in the stock market's growth. While its returns might not be as high as those of SCHG during bull markets, SCHD's resilience during market downturns provides a level of stability that can be particularly appealing to risk-averse investors. It's important to remember that investing in SCHD is not solely about maximizing income. While the fund's dividend payments can provide a steady stream of cash flow, it's crucial to consider the potential for capital appreciation as well. The companies included in SCHD's index are selected not only for their dividend history, but also for their growth potential, ensuring that your investment has the potential to grow over time. Investing in SCHD is akin to planting a seed that bears fruit while also growing stronger roots. The dividends provide regular nourishment, while the underlying growth potential of the companies ensures that the tree continues to flourish. This dual approach to building wealth makes SCHD a compelling option for investors seeking both income and capital appreciation. Remember, investing is a personalized journey, and the most suitable approach depends on your individual financial goals, risk tolerance, and time horizon. SCHD, with its focus on dividend-paying companies and potential for long-term growth, offers a compelling option for investors seeking a balanced and potentially less volatile path to financial well-being. As we conclude our exploration of VOO, SCHG, and SCHD, it's time to reflect on their individual merits and consider which fund might be the most suitable investment vehicle for your financial goals. Each fund offers a unique approach to capturing the growth potential of the U.S. stock market, catering to different risk appetites and investment horizons. VOO, with its broad market exposure and low fees, presents a compelling option for investors seeking a simple and effective way to participate in the overall growth of the U.S. economy. Its diversification across various sectors and its passive investment strategy make it a relatively low-maintenance investment, suitable for those seeking a hands-off approach. SCHG, on the other hand, caters to investors with a higher risk tolerance and a longer investment horizon. Its focus on large-cap growth stocks offers the potential for outsized returns, but it also comes with increased volatility. This fund is ideal for those who believe in the power of innovation and are willing to ride out the inevitable market fluctuations to reap the potential rewards. Finally, SCHD provides a compelling option for income-oriented investors seeking a balance between stability and growth. Its focus on dividend-paying companies offers a steady stream of passive income alongside the potential for capital appreciation. This makes SCHD a suitable choice for those looking to generate income from their investments while participating in the stock market's long-term growth. Remember, there's no one-size-fits-all answer when it comes to investing. The best fund for you depends on your individual circumstances, risk tolerance, and financial goals. In today's digital age, the lines between reality and simulation are becoming increasingly blurred. This concept, known as hyper-reality, extends to the world of investing, where we're constantly bombarded with information, data points, and projections that shape our perceptions of the market. It's easy to get caught up in the hype, chasing the latest trends and making impulsive decisions based on perceived rather than actual value. However, successful investing requires us to see through the noise and focus on the fundamentals. It's about understanding the underlying value of the assets we invest in, assessing their long-term growth potential, and making informed decisions based on our individual financial goals. In a world of hyper-reality, it's more important than ever to maintain a long-term perspective. Just as the S&P 500 index, text overlay VOO, has weathered numerous economic storms over the past century, text overlay VOO, so too will the stock market continue to experience periods of volatility and uncertainty. The key is to stay the course, remain invested, and trust in the power of compounding to generate long-term wealth. Remember, investing is not a get-rich-quick scheme, but rather a disciplined approach to building financial security over time. Navigating the complexities of the investment world can feel like sailing through uncharted waters. However, by equipping ourselves with the right knowledge and tools, we can chart a course toward financial well-being. Start by defining your financial goals. Are you saving for retirement, a down payment on a house, or your children's education? Once you have a clear understanding of your objectives, you can begin to develop an investment strategy that aligns with your time horizon, risk tolerance, and financial capacity. Consider diversifying your portfolio across different asset classes, such as stocks, bonds, and real estate, to mitigate risk and maximize potential returns. Remember, investing is not a passive activity. It requires ongoing research, monitoring, and adjustments as market conditions change and your financial circumstances evolve. Don't be afraid to seek guidance from financial advisors or utilize online resources to stay informed about market trends and investment opportunities. As technology continues to advance at an unprecedented pace, the world of investing is undergoing a profound transformation. From artificial intelligence-powered robo-advisors to blockchain-based platforms, new tools and technologies are emerging to empower investors and democratize access to financial markets. While these advancements offer exciting opportunities, it's crucial to approach them with a healthy dose of caution and skepticism. Remember, the fundamental principles of investing remain unchanged. Thorough research, long-term perspective, and disciplined decision-making are as relevant today as they've ever been. As we venture into the future of investing, it's essential to embrace a mindset of continuous learning and adaptation. Stay informed about emerging trends, but don't be swayed by short-term hype or market noise. Trust in your investment strategy, remain patient, and let the power of compounding work its magic over time. Remember, the journey to financial freedom is a marathon, not a sprint, and the rewards come to those who stay the course and make informed decisions aligned with their long-term goals.